Welcome to Opening Bid here on Yahoo Finance. I'm Seana Smith in for Brian Zazi. Let's talk a little bit about the markets, shall we? Because the market's trying to find its footing over the last week or so. We had the brutal sell-off last week, a bit of a rebound so far this week. So let's talk about where things stand ahead of the Fed meeting and, of course, looking ahead to the next presidential election. Joining me now, I'm very excited for our guest here today. We have Jim Paulsen, veteran market strategist, longtime market watcher. Jim, it's great to see you here this morning.
Well, thanks for having me, Seana. I appreciate it.
Let's talk about what's been going on within the market. Obviously, the massive rally, everyone was excited. A lot of that driven by the AI hype. And here we are taking a bit of a break. What do you make of the recent volatility that we've seen?
Well, I think primarily, there's a lot of factors going on, like last night's debate and all the other things leading up to the election. But I think more than anything else, it's fear of recession that's kind of taken over the marketplace. We had some bad earnings on some of the Mag 7 stocks, which sort of led off, the idea of earnings weakening. And then we've had, some 2 or 3 sort of weaker than expected jobs reports that have come in now. Job creation's growing just 1% now year on year in the last few months, getting close to what you see as a contraction in recessionary conditions overall. And I think people are getting concerned that yes, the Fed's going to ease, but if they're easing into a recession, that's not good for the stock market. So you also see it showing up in the types of stocks that are performing. You're seeing more of the defensive stocks leading this market of late, and more of the higher beta and more cyclically oriented stocks trailing. And that's sort of reflection, too, of investors sort of changing their stripes and their allocations. You're also seeing a huge rout in the bond market. I think the 10-year was down to almost 360 this morning as people are kind of safe haven assets on their mind a little bit. So I think that's really what it is. The thing I would say about that, though, is that a soft landing and a recession both look the same until you figure them out. In order to get to either one, you have to slow inflation, you have to slow economic growth. And I don't really think this to me looks so recessionary as it does soft landing, but I can see why people are nervous about it.
Do you see a higher risk of recession than what we had a few months ago?
Well, I think whenever you slow the economy down and the risk of recession goes up, and so yeah, I think it's somewhat higher if we're growing employment at 1% rather than 2%, then I think that's closer to recession risk. But overall, the thing on recession for me, Seana, is that I think that I've always looked at recession risk not so much in terms of the policies around it that could create it, like tight monetary growth or high interest rates, an inverted yield curve, those kind of things. I always look at it in terms of the vulnerabilities that exist out there in the private sector. If a recession needs some vulnerabilities among consumers and businesses to bite into to create a recession. And if there are no vulnerabilities, it's very difficult to get one. And I think that's kind of where we're at. If I look at the consumer or business sector, their balance sheets are really very, very healthy. Consumer debt to income has been falling really since 2007 regularly. The debt service to income burden is about at a record low since they've been keeping that data back to 1980. Overall, the net worth is up to 760% of income in the household sector, almost a record high. There's $6 trillion of money market funds sitting out there. Well, that's one of the highest ratios of money market funds to income that we've had dating back to 1980 when funds started to come out. So the household sector's, I think, well-financed, not overextended with credit risk, and very liquid. They also have their real wage rates rising, real income is rising. If I look at the corporate sector, they're in a similar position. Their debt to equity ratio is very low compared to post-war standards. Their net cash flow to GDP is close to record highs. The equity to debt ratio is very close to a record high. Corporate profits are at record highs. S&P earnings estimates keep going up. I don't know, where the vulnerability is that a recession can get a foothold in. It's not like anyone's been overextended over their skis. And that's the primary reason why I don't really see the likelihood yet of a recession. I think this is more a soft landing, which is a very good result for stock market.
So then, Jim, has too much been made about concerns here that the Fed is late to the game, that the Fed should have already acted?
Well, I think the Fed's only one player in this and has been all along. The Fed's been late throughout, Sean, and I agree with that. This is the only Fed cycle that I've looked at in post-war history where the Fed practically stayed in an easing monetary position while inflation rose all the way from almost 0% up to 9.1% in June of 2022. It didn't even start tightening until March of 2022. And by the time inflation peaked, the funds rate was still just 1%. So the Fed basically eased all the way up that inflation accelerated, and then it's tightened all the way down. We've never had a Fed do that before. Usually it tightens when inflation's rising and eases when inflation falls. This Fed's been doing it just the opposite. And yet, despite the fact it's been so late, everything's worked out okay. It's not like inflation caused a recession. It's not like it didn't come down again. It's not like the stock market didn't keep going up. Interest rates, bond yields stopped going up. It's like the Fed's been tardy, but it really hasn't had a lot of impact. I think if I look at that now, even though the Fed hasn't yet eased interest rates, a lot of other things have already eased for a long time. The 10-year bond yield is off over 1% right now from its high. It was 5% about a year ago. It's 3.60 this morning. It's down about 1% just in the last 3 months. So there's been a lot of long-term yield easing. The mortgage rate, I think, went to a new low this morning. It's down over 1% as well. So there's a lot of easing going on there. You look at monetary growth. M2 money supply was down about -5% about a year ago. It's now up about 1.5% year on year. It's been accelerating for much of the last year overall. Fiscal juice is still about 5.6% of GDP, which is still one of the largest fiscal deficit to GDP ratios in peacetime post-war. The U.S. dollar is off 5% or so from its high. So the yield curve, the 10s to 2s yield curve has been steepening now for months. So we've got a lot of easing in the pipeline that's outside of the Fed's purview or control, if you will. And I think that easing is going to keep us out of a recession, even though the Fed is tardy. I think there is too much focus on the Fed. Fact of the matter is, you and me manage the growth in the money supply. You and me manage the level of bond yields. We manage the level of where the dollar is going to settle in. And actually, fiscal policy is sort of a life on its own. If the economy slows, deficit spending goes up automatically and vice versa. So while the Fed has regular meetings and television press conferences, the free market, laissez-faire policy officials don't do that, but they do act. And I think they've been easing now for a fair period of time. And with a lag of about 6 months to a year, those policies are going to start to improve economic growth again as we look forward to the next year.
Jim, do you remember looking back on past years when we have seen economic expansion? Do you remember ever seeing or hearing about such persistent recessionary fears? And I guess going back to what you were just saying, it made me think of, I guess, why this time is different. And I think you kind of laid that out there. But why do you think these persistent recessionary fears continue to creep up in the market, even though we have been able to avoid, at least it seems like we've been able to avoid a recession up until this point?
I think it's a great point, Sean, you bring up. And to me, one of the most fascinating aspects of this cycle since the pandemic has been the utter continuation of pessimism in this country, and pessimism among investors, among economists, among companies, among policy officials. I've never seen an ongoing expansion that dates back now until, really the second quarter of 2020, almost 4 years, where we still have consumer confidence measures telling us that confidence among households is still closer to post-war lows than post-war highs. Small business confidence is still close to its lowest levels since they've been measuring that back to the 70s. CEO confidence at best has been middling over that period of time. There's a Gallup poll they do, and that poll remains extraordinarily low. So it is really odd to have an ongoing economic expansion, to have the stock market do what it's done in recent years, go up so much, to have profits go up so much, to have earnings go up so much, job creation go up so much, and still have most people very pessimistic and concerned and see a recession around every corner. I think that there's a host of reasons for that. One of them is I think the pandemic really threw us off, if you will. That was such an odd crisis. It not only was an economic crisis, which it was, but it also was, a health crisis, and life and death matter, like a war, if you will. And I think we've not yet fully recovered from the shock of that, leaving a pessimistic feel in the country. I also think the political divide that we have in this nation is exhibited again last night. Is exhibited by the 50-50 polling, who they want for president. The polarization, and the mean discussions that's kind of brought up in the country leaves a pessimistic feel overall. The other thing that's occurred is every recession tool that we've ever used, Shauna, to predict recessions or to monitor whether they're getting close or not has blown up. Just has quit working. We used the yield curve inversion was gold. If it inverted, we had a recession. That's not worked in this period. If you had a burst of inflation like we had after the pandemic, we've had a recession. Didn't work. Leading economic indicator has been negative year on year for like 2 years running, and no recession. Mortgage rates shot up to 7%, no recession. Money growth was M2 money growth year on year was negative for 16 consecutive months. And after never being negative in post-war history on a year-on-year basis, and yet we've had no recession. The Fed's aggressive tightening policy of taking rates from 0 to 5.5% in quick fashion, no recession. We're left kind of rudderless on how to assess recession risk. And I think when all your tools that you used to use to help you figure out if a recession is coming, if they all blow up at once, then it makes you very anxious. You feel like you got nothing, and I think that's creating some fear. And then I also think just the Twitter space, 24/7 news cycle, just in general, that 24/7 news cycle, we all do it. We tend to spend more time on pessimistic outcomes than we do optimistic outcomes. And the result is, I think, a more pessimistic, concerned, anxious country.
Yeah, Jim, there certainly is a lot to get in there. Hang with us. We're going to take a short break very quickly here. We'll be back in just a minute. All right, we're back with Jim Paulsen, a veteran market strategist. Jim, what you were just talking to, let's talk a little bit. There's a lot to dig into, but I want to get to the election. We haven't talked about that. We had the debate last night. I think investors are waking up this morning trying to figure out, after it seems like Vice President Kamala Harris had a very, very strong performance, maybe ultimately what a Harris presidency would mean for the market. I'm curious from your perspective, is Trump versus Harris, is one better than the other for the market, or how should investors be thinking about the upcoming election?
I've never been a big one on politics having a lot of impact on the macro marketplace. And I really think investors worry too much about that relative to other things that are more important, Shauna. And I think this one's no different in my view. Now, there's always micro things. If you go in specific stocks or specific sectors, and there's a favorite policy by one of the candidates or the other that could directly affect those sectors, that matters. There's no doubt about that. And there's some of those. There's the tariff issue, affects certain things, if that comes up. There's some banking regulation issues, but I think aggregately, I haven't found where there's a great difference. I think what's more important, and as an investor, I mostly like split power. I don't really care who's president, but I just want no party to have all three tri-powers in the political process. And I think that's best for the economy and for the markets. And I kind of think that's the way the founding fathers set it up. They kind of set up this kind of almost comical process where we've got 400 and some members over here, we got 100 senators, we got this other person in this White House, and they say, well, if you all agree on something, let me know and we'll do it. But otherwise, we're going to let the free market economy, laissez-faire, determine most of what happens. And I think that'll occur. The times we get in trouble, I think, is when one party gets tri-power and they can actually do stuff. And then I think that's generally more harmful than when periods where we have a split power in Washington, and most of things are managed by the 330 independent economic agents out there making their own private decisions. So I'm less concerned about who wins the presidency, and I think investors should be too. It's more important, I think, that there's split power, and that's a more calming environment, usually, I think, for the stock market.
Yeah, Jim, that's a very interesting point. And we've talked a lot about why gridlock is oftentimes favored by Wall Street, like you were just pointing out there. So then what should investors be doing? Should they be adjusting their portfolio at all, or just leaving everything, I guess, looking past the election and maybe at some of those other macro factors that really seem to be driving sentiment?
Yeah, I think so. I mean, I think one of the things, getting back to your point on the Fed being tardy, I think that has had a really big impact on where we're at right now. Usually at the start of a bull market, the Fed is in easing mode, and usually they start to ease even before the bull starts. That just didn't happen here. The Fed was in tightening mode before this bull began, and it has remained in tightening mode ever since. In fact, this is the only bull market, Seana, in post-war history where the Fed has been tightening through the entire bull market. We've never had another one that I've been able to find where that's been the case. Why is that important? Because one of the impacts the Fed has had with that, I think, is because it's been in tightening mode throughout, it's artificially held bond yields up higher as well. It's also held money growth lower than it normally is. And the combination of that, I think, has held confidence down throughout the economy. If the Fed's been worried that it's had to tighten the whole time, then everyone else is kind of concerned, well, what does the Fed know that we don't? And I'm going to be a little cautious. So I do think that some of the pessimism and cautiousness that we've seen, and some of the high levels of yields that we still have in the economy overall, some of the low liquidity growth, I think is a result of the Fed's odd policy that they've taken to this cycle. But here's the good news about that. The Fed is now finally going to ease. And if they do, I think this market for a while is going to feel like a brand new bull market. So what do you get at the start of a bull? The Fed eases, bond yields come down, generally inflation is disinflating, confidence starts to improve, and you get kind of a full-fledged, broad-based participatory bull market. We've never had a broad-based participatory bull because the Fed has constantly been in tightening mode. If we now are going to get an easing Fed, we might get all those positive forces: falling funds rate, falling bond yields, rising money growth, greater confidence, still have disinflation, and that could give a feel of a broad-based leadership bull market. So I think investors not should dump the tech new era leadership that's been the narrow leadership that we've had so far. I don't think they're going to collapse, but I think they're going to underperform. And I'd look at broader leadership plays that haven't yet participated in this bull. Yeah. Small cap come to mind, value stocks come to mind, even international stocks to some degree. And I think that's what we're going to see going forward.
So, Jim, that's so interesting. Let's talk about some of those key metrics then that you do look for. And you bring up small caps, and I want to focus on that for a second. Just given our conversation and what we were talking about, the risks of recession, yes, maybe we will see that soft landing, but small caps can be risky, right? Still in this type of scenario. So what should investors be looking for if they are trying to gain a little bit more exposure to small caps?
Well, I think, if you're really concerned, I think still moving down, you don't have to go all the way to smalls. You can move from your large cap tilt to a mid cap tilt. You're still going to pick up some of the small cap flavor. So that's one way to do it within the parameters of your risk tolerance. Another way is to focus on moving to smaller caps, but moving to quality smaller caps. There's a huge difference, for example, between the S&P 600 small cap index and the Russell 2000. The Russell 2000 has a lot more zombie companies that don't have earnings and have are over leveraged and the like. You don't have to go that deep and still have more of a smaller cap tilt. I do think, though, that we could get into a period where the market favors sort of leveraged companies and sort of the more aggressive plays here for a little while if we do embrace the idea of a soft landing, Seana. But you're right. There's no certainty that we're going to get a soft landing out of this. I would say the thing that investors also should focus on a little bit is that much of this stock market has not participated in any meaningful way yet. And small caps are certainly one of those among an array of other stocks. So while we got this small cadre of new era companies that have really done well, much of the rest of the market really hasn't experienced a bull. And that's a very comforting thing, because what it tells me is none of those are too overextended. They're almost priced for a recession right now. They've formed by so much that the market's already priced in a recession. If we decide we're not having one, then there's a lot of upside. But if we do have one, they might not go down as much as they would in previous bulls because they really haven't gone up that much.
So, Jim, we only have about a minute here, but I want to quickly ask you specifically about NVIDIA, given the fact that everything that you were just saying, obviously that has really been the market leader here. Are the best days of NVIDIA, is that behind the stock now?
Well, I don't generally follow individual companies, Seana, but I will say this about that. I think that this idea that we can value a company like NVIDIA and we can say it's undervalued or overvalued, I think is almost nonsense. These companies that we're dealing with today in the new era space are so not only dynamic and innovative and creative, but they are constantly changing what they do. When the automobile was invented, or the airplane was invented decades ago, those things basically do the same thing today that they did when they were first invented. The car runs on 4 rubber wheels and gets us someplace. The airplane basically does the same thing. That's not the case with Microsoft, IBM, NVIDIA, all these other companies. They initially came out as a big mainframe computer, and then it went to small personalized computers and then laptops, and now we got mobile data centers we hold with our phone, and now we're mutating it to AI and robotics, and who knows what the business of NVIDIA will be in 5 years. It could be something that we don't even know about right now. So how do you value something like that? I think these are tremendous companies. I think they're here to stay, and they'll go up and down, but over time, I think they got a lot more upside potential.
All right, Jim, great insight as always. Thanks so much for taking the time. Unfortunately, we have to leave it there, but we look forward to continuing the conversation here on Yahoo Finance soon. Jim Paulsen, thanks so much for joining us here this morning.
Thanks for having me.